Today, we will be discussing Bitcoin halving, a phenomenon that is imminent in 2020. Bitcoin halving is a distribution system for the top cryptocurrency set into the original protocol during its creation in 2009 by Satoshi Nakamoto. This protocol allowed new bitcoins to be distributed periodically without any centralized authority exerting unnecessary control. Bitcoin mining, as we all know, is the process of verifying transactions in a block by solving complex mathematical problems, for which the miners are rewarded a sum of bitcoins. In 2009, during the initial phase of Bitcoin, the mining reward stood at 50 bitcoins per block. Currently, the mining rewards stand at 12.5 bitcoins per block. What changed? Did the mining reward shrink in the past decade? Well, yes it did. But this shrinkage was by design to limit the amount of Bitcoin in supply and ease the impact of inflationary pressure, as set out in the original protocol. The rule implied that every 210,000 blocks, or every 4 years, the mining reward would decrease by 50% or cut in half, hence the name. The first halving was on the 28th of November 2012, when the mining reward decreased from 50 to 25 as 210,001 block was mined. On 9th July 2016, 4 years later, the second Bitcoin halving occurred, slashing the mining reward from 25 to 12.5 as the 420,001 block was mined. The next halving is scheduled for May 2020, when the reward will dip to 6.25 Bitcoin and then to 3.125 Bitcoin by 2024. The halving will continue until around 2140, when all the 21 million Bitcoins will have been mined. What, you may ask, is the intent behind having Bitcoin and making mining less profitable? The answer lies in basic economic principles. If the rewards stayed the same, the miners would increase the rate at which they mine the coin. This would lead to too many coins piling up in the market. And if too much of an asset is in existence in the market, the price per asset falls. Bitcoin mirrors any other asset that has an extinguishable supply, like oil or gold. Since these assets will eventually get exhausted and cannot get minted like fiat currency, the price remains relatively stable. In terms of market movement, some analysts believe that the effect of the halving on the price of Bitcoin occurs not during the actual event, but 3 months to 1 year prior to the event. The second halving in July 2016 did not see a significant price movement as the coin stayed stable around the $675 margin. However, a year prior, the price of the coin was around $250 to $300 and then shot up to $450 by April 2016. To summarize, Bitcoin was created to store value and, more importantly, to remain valuable for a long period. The halving principle allows that by ensuring there will be a limited number of Bitcoins in existence, that is 21 million, in order to thwart centralized control. Hope you enjoyed this video. Subscribe to our YouTube channel and don't forget to hit the bell icon. Find the links to our social media channels in the description below.